Oh, Jesus. I need a hat. Okay, welcome everyone. My name's Jared Wood and I'm the day chair for this evening. Toilets, if you need to go and you don't know where they are already, down the hall to the left, and where else, Jason?
Downstairs, turn right and on the left.
Okay, somewhere down there.
Just after the lift, turn left after the lift.
I would like to, before we kick into the presentation this evening, just introduce a few of our sponsors. Don't need to do that. They were supposed to be here. I'll mention them anyway. Luke Munford from Hopgood Genham and Ben Watts from What's Next. Very important for EO to for us to mention those sponsors. Tenured members, we have David Houston, Ivanka with us, and Mark again, and Steele as well. So good to see you, Steele. And we just have a little update, a chair update from Olivia. Just kick us off.
Hello. As you may or may not know, I am your member engagement. I'll have to think about this because it used to be integration. Member engagement chair and your mentorship chair. Just an update that we have kicked off the mentorship program with a bang. We did our training a couple of weeks ago and paired everyone up, and I'm hoping yet to check in that everyone is sailing smoothly through their first process. So that clearly runs from September till September. Clearly close the gates, so if you want to be involved, that is next September again. I have also, we've all rolled out the KEP program, which is the Key Executive Program. So we have opened the doors to our accelerator program. As you know, I have been an accelerator graduate myself and such an advocate for what it does to the businesses and how it just realigns, and it's done wonders for me and my business. So we've decided to allow all of your key executives to join in the fun as well. So there's 4 key pillars for those ones. Clearly EOers are allowed to attend as well. So any of your top management, if they would like to come on board to those, is great. They also get a coach. So they meet monthly as well, just so that we can keep them accountable to actually move and shake things in your business as to what they have learnt. I am going to be rolling out a youth program as well. So anyone who has children who are 18 plus, just for legality wise and whatnot, it's important to keep the 18 plus, and hopefully we'll get some family for the younger children involved another way. But there's a youth program that is rolling out as well, and they are definitely welcome to join the accelerator program. So it's just literally for those 4 key pillars, and they will get a coach to make sure that they're understanding the program and can move and shake as they wish as well. So to make sure that the accelerator program is still a highlight, clearly they still get invited to the EO events and get a lot more of the coaching one-to-one than the others do. For confidentiality reasons, we'd definitely make sure that we split all the groups up too. That is a bit of update on my end as to what is going on. Hopefully I haven't hounded you with too many emails at the start of this year, and I'll keep them rolling. Thank you.
Thanks very much, Olivia. So before I introduce Carl, who's going to tell us his story around doing deals and things like that, just for the people who are on Zoom, if you've got a question, type it into the chat room and it'll get picked up as we go. Carl will go through his presentation and potentially ask for some questions as we go, and of course an opportunity at the end to ask for more. I met Carl in about 2006 in Chile. We got on pretty well. He left and went over to Canada and moved around the world, and we kept in contact over the years. And I was always amazed at some of the transactions that he was involved in, buying mines, buying mining companies, selling mines, selling mining companies, and those sorts of things. And I followed that journey, and he'll tell you the story about some of the great transactions he did. But then since then, he's left the corporate life and gone into his own entrepreneurial pursuits. And I have been equally amazed at what he's done there. He's restarting a copper mine in Queensland, getting that business up and running and off the ground. And then most recently heading down the path of starting a microbrewery, which is going to be great. Some of the things that I've seen about Carl is, and I've taken note of, which I've tried to learn myself, is that Carl always knows where his walkaway position is whenever he's negotiating anything or working on any deal, and he doesn't let emotion come into it. He doesn't let it cloud any of the facts. And the other thing is that he's got an incredible ability to understand the details of the business that he's dealing with or transacting with, and he just knows all about it. So there's some of the things that I've picked up. I really hope you enjoy his story this evening and take away a lot of these learnings for ourselves. As entrepreneurs, we're always working on some deal, and the learnings that I'm sure you're going to get are applicable in any size transaction. So please enjoy.
It was a pretty impressive introduction. I didn't know I was that good, actually. So it was a really interesting question when Jared said to me, and he's talked to me about the EO group before and what you do and the discussions you have and how you learn from each other, which was impressive. And then he said, look, I think you'd be really good to come in and talk about what makes a good deal. And can you share your experience with how you know when you're doing a good deal, excuse me, and what are you thinking of and what are the lessons and can you sum it up? And it was an interesting question because I don't think I've ever really consciously thought of it before. I've never really sat down and tried to quantify all of those lessons and experiences that I've had in my career. So it was when I sat down and thought, well, how do I do this? I thought the best way to do it is probably bring out some of the deals that are the best examples of some of the key lessons I've learned and how I learned them and sort of go into a bit of detail. So as Jared said, I'll sort of tell my story in a kind of chapter by chapter basis with using some deals as examples. And I'll give you a little bit of time. If I'm not drawing out on the right sorts of experiences, then just feel free to ask a couple of questions at the end and I'll go into more detail where we need. So just a quick bit of a background. As Jared said, I've worked predominantly in mining throughout my career, and it's primarily focused on mergers and acquisitions and capital transactions and debt and equity raising. A lot of it's been on the global stage, so it's sitting in just Hollywood type movies, sitting in Wall Street offices with lawyers and investment banks and nutting out really big deals or being on the ground in some really far out places, looking at assets and buying and selling. But I didn't really come to that through a conventional methodology. When I left school, I originally started an apprenticeship as a communications technician and did that. So I sort of went to work as sort of a blue collar kind of focus and enjoying that and using my hands. But it became pretty apparent to me pretty soon that it wasn't really going to fulfill me. And so I then went back to school, went to QUT and started studying international business, realised that wasn't of interest, and then stumbled upon, of all things, accounting. So I did an professional accounting degree, but I minored in corporate finance, so I sort of focused on that. So I then sort of stumbled into mining again. It was a bit of a, in some ways it was just a bit of luck that I kind of turned up in the right job, and I had a couple of job offers coming out of uni, but the one I decided to take was with BHP Exploration. And this kind of story, the sort of lesson I've learned out of that phase of my career starts with actually a bit of advice an old football coach told me when I was playing in a young team, we were trying to get better, and he looked us in the eye and he said, learn your craft, son. Then when you learn your craft, then you'll be able to go out and you'll be able to win. And so we were young and we didn't really understand that, I don't think, at the time. But when I went to BHP, the lesson sort of sunk in. So I'd been there maybe 4 to 6 weeks. When I first landed there, it was also fresh and new, and I was kind of really excited, and I was coming out of a sort of a study environment where I felt really comfortable in the academic side of things that I've been doing, but I had no idea about mining or what was going on. And I landed in a group, an exploration group, that had companies in countries all around the world. So we had Africa, Asia, Australia, North America, South America, pretty much everywhere except for the heart of Europe, which, you know, there were mines there, but we didn't really have too much going on. So to me, that was really eye-opening, and it was all fresh and new. So I set about learning my craft, and I thought the best way to do this is I need to just go and pester all of these guys and find out what exactly do these guys do? Geologists, geophysicists, geochemists. I had absolutely no idea. I had no idea how the companies that we were looking after fit, why we had them and how we were running them. And most of all, I had no idea about how they saw value. Why did they do what they did? So I went and sort of spoke to everybody, and I sat in their offices to the point that I thought I was being a pain in the bum for them. But I was sort of trying to figure out what they did and how they ran things, and then what could I do, given they were the primary drivers of the business, what could I do to actually help them out? So after about week 6, BHP announced, this is in the late 90s, so BHP announced a massive restructure. Mining was in a massive downturn. If you can turn your mind back to that time, copper was, the pricing probably won't make much difference, but it was about 58 cents, I think, back then. People were going broke. It was a pretty terrible time. And there was a massive retrenchment of about 70% of the staff globally in minerals exploration, and about 60% of the budget got cut. So there was a major rethink in that business about how they went around it, and they became less explorers, and that was the turn of a change in focus for mining companies, the big guys like BHP and Xstrata and Anglo, where they really became focused on being cash generators. So it was a massive cultural shift. And so the general managers going around next week, redundancies are being announced, and everyone's getting a visit in their offices, and I'm expecting, and I've gone home to my wife and said, this is the shortest career change in history. 6 weeks and I'll be gone. So the next week, Tom Whiting is going around to everyone's offices, and he's knocking on the doors, and he's sitting down with everybody. I'm just waiting for my turn, and he walked in and he sat down, he closed the door, and I was sort of prepared for it. And I thought, oh, well, okay, it was nice, a good bunch of blokes. And he said to me, listen, you're the first accountant who's ever come and sat down and actually tried to understand what it is that we do. We've never had anyone who's walked in and really understood the business and actually asked, what can I do for you? And he said, unfortunately, your boss isn't as well liked and has never really made an effort to do that. So we think you can do that job. Would you be happy to do that job? And I went, well, if it's not going to get me sacked, I'm pretty sure I'll figure it out. So that was sort of the lesson for me, and it sunk in that when I was going to something, it didn't matter how daunting it was, how new it was, or how complex or how technical it was, or how fresh it was, that trying to figure out and understand the most I can about that business meant I was not going to get in trouble with that knowledge. It was always going to help me out of all the unexpected challenges that would pop up. So I could never have foreseen, 4 or 6 weeks ahead of that, I couldn't have foreseen that there was going to be a mass redundancy. So it was a simple wanting to get to know the business and a natural desire to understand the business that saved me really in the end, and then put me on the path to where we are today. So that's my first key lesson, is that learn more about the business and it will get you out of all the unpredictable and unforeseeable events that you have. Moving on from BHP, which I spent a lot longer there, but it was sort of fairly mundane, run of the mill. But moving into something, again, that was quite new for me, was a fresh company that had started up, actually bought MIM here. It was called Xstrata. And so I got a call from the CFO of Xstrata Copper, who I'd worked with in BHP. And he said, look, we've got a new office in Santiago in Chile. We don't have any presence. We really want to start growing things. We reckon you can come and do a bit of a dual role for us here, a finance role and a growth role. So we can set about looking for acquisition targets, as well as we need someone who can look after the companies within South America. So it was a really interesting company. And if anyone knows the background, which you probably won't, it grew quicker than any other mining company has sort of ever grown before. And it grew exponentially. So it went from a very small startup company with a couple of coal assets. in the space of about 3 years to being one of the 4th largest diversified mining companies that there was. The MIM acquisition was a big part of that, and another one later on called Falconbridge, which was a Canadian company, was another part of that massive and steep growth and learning. The thing about Xstrata was it was ego-driven. It was just, and it was openly said. So Mick Davis actually, and I recall Mick Davis in London, it wasn't speaking to me, but I was there, and he said to someone there, "Don't you know, son, we're an ego-driven company." When someone was questioning the wisdom of being so ambitious. And so that ego within Xstrata had emboldened it. It had told it that it didn't need to be scared of the big guys. It could compete with anyone and it could pull off any sort of deal that it wanted to do, which was great. And it drove that growth. And so I learned then not just to be confident in myself, but to also be a little bit more aggressive and to be able to take on a few deals. And we did, one of the deals when we were in South America was the acquisition of Tintire from BHP, and Jared was working with BHP at the time. And that, I think that lesson was pretty bold. We weren't seen to be the front runners for Tintire, but I think the planning that we'd put in there and the fact that we were bold enough to go and put ourselves in front of BHP and say we were the natural owners of that asset paid off. But one of the things that then soon became apparent to me as we were going on, that ego was great when it was driving the growth and there was some logic behind it and we had good plans. But it wasn't too long before I realised that the ego was going unchecked. And there was a range of projects that we had in the portfolio. So we had about 6 development projects. In copper terms, each one of these normally takes about 10 years to develop, and they're upwards of $3 to $4 billion. And I looked at the development portfolio and recommended to my boss, who was the director of corporate development for copper at the time, and said, if you look at our development pipeline, it's bigger than BHP and Anglo's put together. And those 2 companies have been developing assets for a lot longer than we have. Why are we holding on to these assets? Shouldn't we? And each one of them was consuming around about $100 to $200 million a year in development capital before we started building. So that was feasibility studies, holding costs, community expenses. We're sitting there and I'm going, there's no way we can develop all of these. And each one of them has got somewhere between a $3 and $6 billion development cost as well. So you're sitting there and you look at that and you go, well, how are we going to finance that? How are we going to manage this? Why don't we pick the best 3 and get rid of the next 3? Because it was pre-2008, it's pre the GFC, and you know, logic said that we shouldn't be hanging on to them. And when we looked at it, it was being a little bit realistic. And it fell on deaf ears. And it fell on deaf ears because the CEO of Copper at the time had banked his status in London with Mick Davis and the Exco that we can do it. And I didn't know that at the time. I was told that later by some of the guys in London. But that ego was to the point that senior executives were staking themselves in the ground and they weren't backing away from it. So it was one of those things where you knew not to push. You'd sort of pushed it to the limit and you got to the limit and we backed off a bit. And then shortly thereafter, the GFC hit. And that hit when just after I'd moved to Toronto. And what happened then was we'd had another deal in nickel called Jubilee, which we'd taken on about $4.5 billion worth of debt for. And we had all of these assets in copper. So that ego had meant that we'd pushed so hard, the balance sheet was stretched and all these assets were there. Share price went from £43 down to £3 and was never going to recover from that because we'd overextended ourselves, and that great run of taking the share price from a standalone coal asset through to being one of the I think we were the 3rd or 4th largest diversified company by market cap at that stage just vanished in the space of about 30 days. So October 2008. So that was, I think, one of the next major building blocks for me in learning what makes and what constitutes a really good deal is that you need a little bit of ego, because that little bit of ego is going to make you do things that you're scared of. It'll give you the confidence to say, actually, I can do this. But if you let that ego run unchecked, if there's no dissenting voices in the boardroom or there's no dissenting voices in the decision room, then that ego will lead you to disaster eventually. You can't stop it. It's going to end up there. So Or I should say, my view is, as Jerry keeps saying, it's what you would do, not what other people would do. So yeah, my view is that that ego unchecked would lead me into a really dangerous situation where eventually it would backfire at me. So the lesson I learned is keep your ego in check. And if you can't do it, then I need somebody else around me who can help me do that. So you need that devil's advocate voice. So that's where I sort of moved on to probably the next most important. And I sort of haven't stopped because I think they're little lessons, but if anyone feels like they want to ask questions about those two sort of learnings, I'm happy to take a question. But the next move that I made, so at that point in time, I think I'd learned my craft by then. I'd done my apprenticeship and I was ready to go. So I made the move out of Xstrata and went to a mid-tier copper company based in Perth called Equinox Minerals. And Equinox was, at that stage, about a $2.5 billion company. It had been founded by a gentleman named Craig Williams who, when he founded the company, it was a $15 million exploration company. And he had discovered and developed a project in Zambia in Africa, which was an incredible feat on its own. And it was noted as, or thought of as, one of the only tier 1 style copper deposits, which is a high-end, world-class copper deposit that a major diversified miner might want to own. It was one of the very few tier 1 copper deposits that was in the hands of a standalone pure play copper company. So that made it pretty attractive. And actually, unbeknownst to Craig, when he hired me, I was actually buying his stock on the open market for an acquisition. So I actually held just short of about 5% of his stock. But we talked about that later, but not at the interview, that's for sure. So look, I joined Equinox, and the Equinox at that stage had just gotten Lumwana, the asset in Africa, up and running, and they were really looking forward to the next stage of growth and said, we've built this base of an asset. We want to grow now, and the board wants us to grow, and we want to take the company to the next level. So I joined and was loving it. And it was the first time for me that the question of what if this all turns pear-shaped was solely resting on my shoulders. So I wasn't part of a large team recommending to boards we should do this. It was me recommending to the board then, this is the deal for us. This is the right deal. We should be doing it. Here's the risks. Here's all the damages. So, I mean, at the end of the day then, it was the first time I'd really sat back and thought about, okay, if I'm wrong, what happens if I'm wrong? And that was going through my mind as I was putting through, we were looking at all the various acquisitions. And so we're a copper company. We knew that we wanted to stay a copper company. We had a market cap of about $2.5 billion. We had minimal cash flows coming out as the asset was up and running for about 6 months at that stage. And we were just starting to take off. And so we would have been looking at cash flows of around about $50 to $100 million within about 12 months. So we were sort of limited in the capacity that we had to do deals. So what we had to do was identify something that was going to keep us a pure copper play, was going to be a strong fit with the rationale that our investors had with us, and was going to not put us in a position where we blew our brains out and overstressed ourselves. And I guess that came to the unknown situation. We'd just been through the GFC, and it was fresh in everybody's minds that something could come out of the blue, something that we don't expect. So not only do I need to plan this for all of the things that I can see and can foresee, I have to plan it for all of the things that I can't foresee. And that's when I learned, or I put into play, one of the lessons that I think is probably one of the most important things around deal making, is that I needed to be prepared for all of the outcomes, and I needed to be happy with all of the outcomes. So I applied a little bit of ego into this and looked at what was around, and we came up with an asset that was actually located in Saudi Arabia. That was a little scary for both the company and the board because, you know, Saudi Arabia, Middle East, post 9/11, it's not exactly the most friendly place in the world. It's pretty difficult to get into as well. So we did immense due diligence on it, and I had to do probably 2 to 3 stages of due diligence and analysis before we could get that to the board to be recommending a way to go forward. We did that behind closed doors initially, And the risk with a company where Equinox was seeing that we're fresh. This is the first time that we're doing a deal. If we do something out in the open and out in the public, and this was going to be an acquisition of another listed company, if we did that in such a way and it didn't come off, we could severely damage the market cap of Equinox. We could embarrass management, we could lose credibility. There were all sorts of negative outcomes that could come our way. So a few of the key questions that I had to answer was, A, is it the right asset? How do you know it's the right asset? And so we used extensive diligence to make sure that we knew what was in the ground. We got the right people involved. So where we didn't think we had the right people in our own company, we brought in the right consultants. And where we needed to do any of the in-country diligence, we brought in in-country experts for the Middle East where we had a lack of experience. So we sort of recognised pretty early on what are the things that we knew and we were good at that we could apply, and how did that asset fit with our assets? What are the things that we didn't know and we didn't understand, and brought in the right people? And I think as Jared mentioned earlier on in his intro, which was really quite nice, I have an ability to be able to know enough to be dangerous for everybody. And so one of the things that I would apply when we were looking for consultants to help us there is to try and understand from those consultants if they could explain something to me. So if there was a problem and they couldn't explain it to me, I'd try a few different angles. So I'd try and get them to explain it a different way, and maybe a third way. And if after the third time they couldn't explain it so that I could understand it, I knew I didn't have the right person. Because if they can't explain it to me, they don't understand it properly themselves. And so that's one of the things that I would apply whenever I was selecting the right people to come along as well, or to engage to assist us. So we got to the point where we were really comfortable that was the right asset. Then we came up with all the questions, and every time I was saying to Jared, I felt like at this stage, every time I went into a board meeting, I'd come out exhausted. I'd come out completely beaten up. The number of questions and the detail that the board wanted to go into. And I at this stage, I'm thinking, they don't really want to do this. You know, I've come here, they don't want to grow. They're just really growth averse or risk averse. So it took me a really long time to convince them. But they then started to focus on pretty clearly, okay, so what if you get this wrong? Like, what if you go and do this deal and the deal doesn't work? What if you try to negotiate something and then we find out that the price is too high? What if all of these things happen and we're totally embarrassed? What's the outcome? And that's where I started to put a lot of effort into understanding, okay, so what are all of the outcomes that could actually happen here? And so all of the outcomes, when we looked at them, we said, well, the realistic outcomes are, we could say we're going to do this deal, and then for whatever reason that breaks down. You know, the agreement with the other party breaks down, they walk away, we become embarrassed. It gets really hard to be able to go and do another deal again in the public markets. They're very unforgiving like that. So that was one outcome. And then the other outcome was, before I say that, so the way we dealt with that was we did everything behind closed doors. We decided that we weren't going to tell anyone we were looking, and we weren't going to publicise it, which was a mistake I think a lot of smaller companies made, is they would often try and tell the market what they're going to do instead of what they'd actually done. And that would often lead to a lot of embarrassment, loss of credibility, and a bit of the boy who cried wolf syndrome. So we did it all behind closed doors, and we made sure, and we said, if you start talking to people and rumour gets out, we're out of here. We're walking, we're not going to hang around. So then when we finally got an agreed position with them, we made sure that we had them locked up. So we had non-compete clauses, we had no shop clauses in the contracts. We pretty much had all of the management team locked up and all of their options and shares locked up, and we had all of the major shareholders. So we also then secured 19.8% of the shareholder base to sign an agreement to lock up and sell into the deal before we announce the deal. So we probably, in a normal deal, we probably wouldn't necessarily have to go to that extent, but we really went to that extent because we didn't want anything to be left behind being our first deal. So we thought about every single way that we could lock somebody into a contract, and we included that in the contract and that agreed sale. So that was one way that we dealt with that risk, and that made the board quite comfortable when we finally came to them and said, here's the final form of the deal. And one of the board members was actually a lawyer, and he drilled down, and so once he got satisfied, the rest of the board were happy. We then had the second problem though, which was the more dangerous problem. So it's kind of easy to get your contract right to lock everybody up. But the more dangerous problem that we had was, okay, once we announce it, we go out there, they can't actively and knowingly go and search for a way to get out of this deal. But it's in everyone's best interest to go and find someone who's going to put a higher bid on the table. And so you know that they're going to go and do that. And we knew that they were going to go and do it. Whilst we loved the asset and we liked some of the people that were in the company, we knew that they really had no intention of ever taking the company forward. They were on the verge of commencing development, but they were never going to do it. So we understood their sort of real motivation for a deal at that point in time. So knowing that, we knew the first thing that they would do was use backdoor channels to try and get everybody to understand where the extra value might be, to be able to get messages out to people, to really get someone to come and put an offer on the table that they had to consider under both the law and the contract. So that was when we said, okay, so how do we combat this? Like if we've got them tied up, but they're going to be able to still use back channels, what do we do? And what we did was we engaged an ex-journalist from the Australian Financial Review as our media consultant. And this guy knew everybody. So he knew all of the current AFR journalists. And in fact, he was a mentor to a number of those guys who particularly wrote in the mining section. And he knew everybody in the Australian, and he knew everybody in the Age, and he knew all of the journos. And his family was actually, I think his father was a professor in the School of Mines in Kalgoorlie, and so he was actually quite connected into the mining world. So he was highly networked, and he knew everything that was going on, to the point that when we engaged him and the deal was out in the market, it got announced. The day it got announced, both share prices went up, which was really unusual. You normally see a mathematical metric where a share price will go up, one will go down, and it's usually the target goes up and the buyer goes down because you get dilution in. But we had both go up. So that made the board feel really good. It made us feel pretty good, but then the really hard work started, because they did start to do exactly as we thought. They started to try and get the messaging out to different companies, other copper companies in Australia. So we had used this chap that we engaged to go out there and control that messaging, to the point that he was getting phone calls from other journalists saying, hey, I've just been given this backdoor story, and it's basically written for me, and it's come from their PR firm out the back door. This is what it said. And he said, well, I wouldn't put that in your paper because of X reason. And so he was actually able to squash. So he killed and completely controlled all the messaging, the public messaging. So what the public saw and what all the investors in the market saw was a completely smooth transaction. Whereas underneath that, it was actually the most hostile, friendly takeover I've ever been involved in. And it was quite friction. There was a lot of friction between the two management teams, to the point that the CEO, as soon as she could, when she'd sold out, she sold her shares and dropped it off. And she'll be sorry, because if she'd held on to them for 6 months more, she would have doubled her money. But that's another story. So for me, the lesson that I got out of that whole process, and what was really interesting was that even though I felt beaten up by the board and I thought they hated the deal and I thought they were risk averse and they didn't want to go anywhere near it, we finished it. We're having celebratory drinks when we're closing the deal and we're taking everything over and doing the normal, here's cheers, well done. And I said, oh, I'm glad you guys finally like it. And, and the chairman looked at me and said, what do you mean? We loved it from the time you brought it in, but we're never going to tell you that. So I had this devil's advocate in the room, which ties back to the ego story, that while I thought it was a great deal and I thought this is exciting, we can do this, this is hitting the mark, they never once let themselves get carried away with that ego. So they were always making sure that I was in check and that my ego was brought down. And I think that's probably one of the reasons why it was really successful. The other key reason was that when we looked at the deal and we looked at what we had to do, we looked at all of the possible outcomes and we thought, Occam's razor, if something's possible, if something will occur, then it will occur. So we need to be happy with anything that can happen. So we needed to be happy that if something could happen, we could live with it. And so if we weren't, then we realised we had an issue that A, we shouldn't be doing it, or B, we need to stop it so that that can't happen. And so that was some of the key lessons I got out of that. Is there anything on that example? Right? Everyone's happy, that's good.
I can actually ask a question there, Carl. You talk about the analysing the interests of the other party, the other person, and all that sort of stuff, and the uncertainties around that. How do you deal with uncertainties when you're preparing that plan?
The unknown outcomes, do you mean?
Yeah, things that you can't be certain of.
Yeah, so I think the key there, when I say you have to be prepared for all outcomes, I think you need to accept that you can analyse something and you can look at it and say, it's a possibility, but it's a highly unrealistic possibility. So yes, an asteroid could hit the Earth, but is it going to? Are we going to see it coming? Probably. So there'll be some indicators. So there's some that you can dismiss. But I think in terms of those things that are probably more realistic, the possibilities.
I didn't ask the question in Zoom. So the question was just about how you go about analysing the uncertainties or dealing or planning for the uncertainties.
Yeah.
Sorry about that.
It's okay. So I think the first part of the response still stands. So that there are some that you can probably put aside. You don't need to be silly about it and be too unrealistic. But then the others that you can't really put aside, where you look at it and you say, well, what could you just need to sit there and say, if there's a possible outcome here. So I don't know what it is, but let's say I don't know the cause that's going to happen, but I know that something could happen that creates another financial crash. So you need to plan. Okay, so if the world crashes tomorrow, whatever the cause is, are we going to be okay? Are we going to be happy with the outcome? So I think you really need to run stress tests. And the way we did it was we would build very detailed models of the mine. So they'd be working models of the mine from digging the ground, from the geological model, three-dimensional geological models, the mining plan, which would work off the three-dimensional models. That would then roll into financial models, which would tell us when we're pulling out a block of dirt and how much copper or how much iron ore or coal that's in it. That would roll down into really detailed working models of the mine that we could run various scenarios in. We could play with copper prices, exchange rates, different things. So in mining, you would do it through really detailed stress test analysis as one test of what you're doing. Some of them might not be financial though. Some of them might be more people orientated, for example. So what's another person going to do in this given situation? And I think that's where you might need to find protection that you put in the deal. So sometimes it might be putting those protections in a contract that we talked about. Other times it may be you just need to spend time and really understand if they're the right people and what their motivations are going to be. So I'm not sure if that answers everything or, yeah.
Yep, thank you.
That's good. So Citadel was our first, in Equinox, it was our first deal. It was the first deal that I was solely responsible for as well. So I sort of wear that one with a bit of a badge of honour, and it was a highly successful deal, which made it even better. That was just before, that was in 2010, and that was just before the floods here in Queensland. And we were living in Perth at the time, but it was my 40th birthday, and so we came back home over here and we went up to the Whitsundays and we went sailing around in a boat for a break and holidays, given we'd been so busy with Citadel. And so I was out of radio range for, I think, probably 2 weeks, and then got off the boat. And of course, as everybody's phone does, your smartphone starts pinging off and thousands of emails and I'm getting these calls and alerts and everything else. I'm going, oh no, what's going on? And so I'm looking at the news, and our very next target that I've seen was a company called Lundin in Canada. And Lundin and another company called Inmet had decided to put together a merger of equals. So that simply meant that they were merging, no premium, joint control, and they were planning on, one had a massive copper project in Panama, and the other had a number of assets, some in Africa, just near ours, and some in Europe. similar styles of assets to the one that we just bought in Saudi Arabia as well. So Lundin, we thought, had a really strong fit with us because they had another tier one copper asset that was just over the border in Africa. And then they had some, without going into too much boring detail, some VMS deposits, which are extremely long life assets and high grade assets with the similar type that we had in Saudi Arabia, and they had them just over in Europe. So when we started to look at it, it was a really neat tie-up. And the reason I was so disappointed was because it was the next target that I wanted to go after. So I was a bit disappointed and was listening to a lot of the news that was coming out. And the news that was coming out, I started listening and they started talking about, they were pulling together and making this company that they thought would turn into about a $7 or $8 billion company. And after Citadel, we'd gone from about 2.5 to around about $4 billion in value, which was a really good outcome. And copper price, after the GFC, had still started to ride high. So there were a lot of things going our way. What we'd had, though, with Lundin is I started to hear messaging coming out of the investor presentations that they had, which was talking about this unknown copper company that would be their next target, that would take them to 15 or 16 billion and take them into the next upper echelons. And I started listening to this and I was thinking, are they talking about us? And I got more and more convinced that they were talking about us. And I spoke to Craig, the CEO, and said, Craig, these guys are talking about us. Like they're coming after us when they get this deal done. We're next. And Craig was a bit dismissive. He goes, "Oh mate, you're being paranoid. You know, you're letting the last one get away from you." So he didn't really think too much of it. He was then going to Livingston in Africa and doing an investor conference there, which all the sort of African-based copper companies would go to. And of course, that meant Lundin was going to be there. And I get a phone call from him, not quite in the middle of the night, but pretty late, where he's going, "Girls, I've just spoken to Lundin's head of corporate development, and the stupid bastards just told me we're next." So this guy had actually opened his mouth and told the CEO that he was going to come and buy his company that he'd founded as a $15 million exploration company, was now $4 billion. They were going to do this deal and come after us. So of course, the first thing he did, he got back and we had a conversation with the chairman. And he said, "Oh, I'm glad you guys," he said, "I've been listening to this thinking that's us they're talking about." So again, we all sort of ended up in the right position, but it was good that we did have a devil's advocate in the room, again, which tested everybody's theory that we weren't just getting carried away with ourselves and thinking they were talking about us. But so we sat there and again, we had a board conversation, quick board call. It wasn't really a board meeting, but the question mark in there is, well, they're talking about us. They've now told Craig they're talking about us. If we sit here and do nothing, are we going to be happy with the outcome of sitting and doing nothing? And our view was, no, we probably wouldn't be. And I think if we sat there and did nothing, there's no premium, we don't get any rise. And we thought, we need to start to take our destiny into our own hands here. So again, we needed to sit down and thought, well, what are our options? A, we can do nothing. B, we can actually break up their deal and jump in and start our own acquisition and buy Lundin. And of course, again, the beat-ups started in the boardroom. So I started getting beaten up again, going, well, if we do this, can you do this? And can you do that? And can you get it there? And you know, I was saying to them, yeah, look, I'm confident we could break this deal up before their shareholder vote. And we can finance this and we can close this deal really quickly. Now, one of the reasons they were beating me up was because it was going to be a $4.5 billion acquisition, which was about the same as our market cap, or maybe slightly more. And it was going to take about $3.8 billion in debt. And I had to organise that in about 3 weeks, which we did. And so we got the debt organised. We had a component of equity and we sat there. But if I go back to that lesson of understanding all the potential outcomes and, you know, being happy with them, and that I think is one of the keys. If you're lining up a decision of, do I do something or don't I do something? I can't probably stress enough how important for me it was to say, what are all of the options that could happen here? And given that any one of those options could happen, am I going to be comfortable, or am I going to sit there and go, oh, I can't live with that outcome? And if I can't live with that outcome, it means that I shouldn't do it because I'm exposed to something that I can't afford. So when we sat down and we got to that final decision about whether we do this, the board said, all right, so what could happen here? And we said, all right, what could happen is we sit here and we do nothing. If we do nothing, nothing happens to our share price, nothing happens to us, but we know they're coming for us and we know we're going to get what we believe is an undervalued offer for the company and we're not going to deliver shareholder value. If we do something, we've got three main outcomes that could happen. And the first outcome is we're successful and we jump up and we become the $8 or $9 billion company with market cap, ready to do the next deal and move on. And so we start to control that space and we start to become the next sort of growth mid-tier company. If we launch it and we don't succeed, then would we be any worse off? And we said, well, we'd probably be a little bit embarrassed, but we have the protection of having done a deal. So we can live with that. It wouldn't be silly. And the interest that would generate, knowing that the reason we're doing that is they're possibly coming after us, should then generate more speculation around their share price. We should see a lift in the share price, and at least we'll have generated some interest in us and some activity. So we wouldn't be sitting there with our hands tied behind our back saying, well, we're not in control of this. And then the third option, which was probably seen by some of our board members as our worst case scenario, was we actually put ourselves in play immediately. So we go and do the deal, and before we can get any of this finished, someone launches on us. So we sat down there and everyone thought about those options. And again, it came down to the situation where we were actually really comfortable with all of the options except for the one of doing nothing. And the one of doing nothing was where we said, well, we can't do nothing because if we do nothing, we've got no control. We've got no say over what happens. So we set about launching the acquisition and we raised $3.8 billion in long-term debt. So one of the other things that we did with that, and we looked at all the things that could go wrong, back to Jared's question, is we said, okay, well, what we need to do if we're putting this deal on the table is we need to make this offer so sweet for our own shareholders that A, it's going to be really attractive for Lundin. It's going to be better than the merger of equals, but we didn't really have to add a premium in because merger of equals, no premium. We could get away with a 10%, 15% premium. Lundin shareholders are still better off under our offer than they would be under that merger. So we could secure that access or that success pretty easily. By also doing that then, and by throwing what can be an aggressive amount of debt in, we were able to actually generate a lot of shareholder value. So the accretive nature of the transaction for our shareholders was so good then that our share price would and should react. But importantly then, it became a protection for somebody else who wanted to come and buy us. If someone did then launch, and we did put ourselves in play, we will have put a number on the table for ourselves that's actually so high that the offer they would have to make would be a knockout offer, and we would be really happy with that, particularly Craig. So that was sort of where we sat and how we structured the deal. So we were quite aggressive on the way that we structured the finance between debt and equity because that set a price on our company and the target on our company that was an extra protection that we would have should we get the worst case scenario popping out. And we were really comfortable that any premium, because they weren't getting a premium, any premium would be successful. So we put that deal together, we structured it, we launched it. We copped a little bit of grief from some of our shareholders who thought the size of the debt after the GFC was ambitious. And it probably was. But again, we looked at, all right, what are the possible outcomes of putting $3.8 billion worth of debt into this? And the outcome is getting your debt called on. So as long as we can service the interest on the debt, it's when we had to pay the debt back. So we took the option of paying slightly higher interest, but having 10-year long-term bonds in play, which meant we could refinance them in 7 years, and you can, a bit like the government is doing now, you can take on more debt. If your market cap keeps growing and your company keeps growing and you keep the debt at the same level, you refinance it, it actually becomes a much smaller proportion of your market capitalisation. So from that perspective, we looked at how we structured the acquisition and how we structured the capital that we needed to buy it. And we set the value points for them and us at points that were irresistible for both groups of shareholders, particularly if someone else came in. And that all went really well. So that plan worked. We went on a 24-hour-a-day open bid because Lundin were listed in Sweden and Canada, and we were listed in Canada and Australia. The deal was live 24 hours a day. Each one of those exchanges, they all had overlaps. So we were constantly going. So for about 3 months, I think, throughout this whole period, I slept for about, on average, 3 hours a night, which was fun. It was good fun. It was really enjoying. When we got it done, it was good. But we were a week out. We actually had it done. We had the numbers, the proxies were in. The Inmet and Lundin deal fell over, and so we successfully broke that up, and all the shareholders withdrew their acceptance from that deal. And we had all of the Lundin shareholders up to about 65% a week out from the deal into our offer. So we were sitting there cruising, and of course that's the time we shouldn't be too comfortable because you know something's going to happen. And we started getting calls saying, I'm hearing that there's some people sniffing around and we don't know who it is, but we're hearing something's coming. So what we'd done is we had, I think, looked at all of the potential outcomes. We'd kept our ego in check at that stage, and we'd learned as much as we can about everything that we could in the market around the deals, and we were quite comfortable. But what we eventually had happen was the worst case scenario that we wanted, which actually turned out to be the best case scenario in the very end, that someone launched on us a week out or less than a week out from that deal being done. And in fact, we were on our last roadshow with our own investors just before that deal was to be done. And so it was Sunday evening they launched, and they made an offer of $6.3 billion US, we're talking about, for Equinox. So we'd achieved at least what we wanted to, is that if there was a competing bid coming, it was going to be a knockout. So this is in the space of 2008 to 2010. Into 2010, we'd gone from $2.5 billion to $6.3 billion. All in the back of making sure that we learned these lessons and we lined up the right assets that we wanted to put in place. And so that brought us to the next point, or the next lesson, oh sorry, not the next lesson, but it brought back one of the lessons. Ego stepped in again. And to our benefit, it was the ego of another company. So of course, the first thing that we do is we go and see our shareholders the next morning. They said, you didn't actually have to turn up today, given what was announced last night. We said, no, we'll turn up. We're in play, we accept it. The Lundin deal's dead. We're not going to be able to complete that, given everyone's going to pull their support and they're going to buy into the new offer that's in the market. But we're going to look for another offer. We're going to look for a white knight. And that was always one of our options when someone came out. Now, we didn't need that to be successful. So again, it's another one of the options that we would search for a white knight, but if a white knight didn't materialise, it didn't bother us because the offer's already out there and we were comfortable with the offer that we had. So we searched. We went to all of the guys that we knew were looking at us, and again, it's that knowing what's going on. So we had identified all the people that we thought were interested in us, and we knew they were, and we invited them all into a data room. But it was the one person that we didn't expect that came in that ended up being the ego-driven company, which we loved, and that was a company called Barrick Gold. Being a gold company, we didn't think anything of, didn't have them on our list of looking for a copper asset. So Barrick Gold jumped in though and went through the due diligence process. And that ego that I was talking about actually took the offer from $6.3 billion to $7.5 billion. So we leveraged off the ego of that company. They had convinced themselves, excuse me, as the world's largest gold company, that a move into copper was the best thing. The second thing that they convinced themselves of is that their ability to forecast copper price was better than everybody else in the copper industry, and they'd forecast $4 long-term copper. And so they, excuse me, had valued the asset and our assets based on $4 long-term copper. So we closed that deal 2 days before the copper price hit its peak post the GFC, and it dropped like a stone for the 3 years following that deal. They burned something like $7 billion worth of value in the end, and then ended up selling it. So that was one of those lessons again where ego is really good, but if you see somebody else with that ego unchecked, ride it out and go for it. Let them play it out, play to their egos. So they were a company that we hadn't expected, as I said. We didn't think that they would step into the realm or step into the transaction, but they did. It started off one of those fantastic, I guess, unknowns that you don't expect that come out that's an upside of an unknown. And we hadn't really planned for that, but the opportunity was there for us to take advantage of it. And they played out. We really didn't have to push them too hard from the market's perspective and our shareholders' perspective. They all patted us on the back and said it was something that we'd done. But really, I think it wasn't actually something we'd done to get them up. It was all of the good planning that we've done and the structure that we'd done before that. So it was everything we'd done 3 months before or 4 months before that that had set the foundation that meant that they got carried away with themselves and thought that this is the right thing to do. So that was, that's a lesson of where ego can be good, particularly if it's in the other side of the transaction rather than on our side of the transaction. So I love that ego when it's doing that, but you hate that ego when it's hurting you. The other thing about that situation, again, comes down to the options, but it's a little bit of a variation on knowing all of the options. And it was never stress if your plans go astray, because no matter what you plan, guarantee you it's going to go astray, particularly in a transaction or a deal. Excuse me. I don't think you ever get a situation that goes exactly to plan. And I think that was an example where we'd planned as much as we could for everything, and then we just let it roll, and we went with the flow. And if the deal structure or the market took a turn, we just went with that, and we didn't try to fight it. We didn't try to hang on. And I think that was one of the things that surprised some of our shareholders the most, that we'd committed to this transaction and we'd sold it and we'd got it essentially over the line a week out from the transaction. But when someone had launched on us, we quite calmly walked in and said, no, we're in play, so we'll get this price up. And they looked at us and said, well, two things. One, excuse me, how will you get it up? This is already this is already beyond what we see as your target price. And two, you guys are comfortable in letting this roll. And we said to them, we're pragmatic. We'd thought of all of these potential outcomes when we launched the deal. And I think that surprised them the most. I think there's not too many companies that had walked into those guys and said, we were aware this could happen and we're actually prepared for it. And it's not a bad outcome. Excuse me. So running from that, I guess, or moving on from there, one of the lessons is patience can sort of be a beautiful thing. Because if you plan for it, you can be patient, you can be happy with whatever comes out. You don't need to sweat on a particular outcome. And as Jared said before, it's your sort of walk away point that if you're comfortable with all the different outcomes, then you're comfortable walking away if something doesn't go well, or you're comfortable taking your time. So we all walked away from Equinox pretty happy and economically rewarded. Sat down, exhausted for about 6 months, and then thought of what to do next. And as Jared said, this is where I sort of think I became a bit more entrepreneurial rather than in the corporate world. And I sat back, we'd moved back to Brisbane after being on the road for 11 or 12 years, and decided that there was a real opportunity following the GFC and following all of the consolidation we'd seen, where a lot of small copper companies had disappeared. There was a real absence of any genuine copper companies in Australia. So I saw the opportunity to start a new company from scratch, which is what we did here, and I founded a company called Lighthouse Minerals. Started off with me and a desk, and then it became me and Greg, who was a lawyer and accountant at Equinox, who came over. And the two of us started working on the plan, and then eventually brought in a few of the other Equinox guys on the board to sit on the board and bring their expertise in. So what we decided to do was look for a copper asset that was unloved or being mismanaged. After the copper price had started to dive, we started to see that people were making money, whether they were good operators or bad operators, when copper price was at high $3 and $4. But when the pressure was on and you returned back to times where it wasn't so easy, only the good operators were surviving. So there were a lot of assets turning over. So we saw an opportunity to get in when prices were going down, start a new story, and see if we couldn't replicate in some ways the Equinox story. And I don't think we'd set out to sort of go from $15 million to $7.5 billion. I think that's sort of a one-off. But what we thought is that there's easily a way to look for an asset here that we could pick up for the $50 to $100 million range and turn it into a sort of a close to $1 billion type asset. So we sat down and we thought about how we would approach it, and we looked at all of the assets that were around the world, and we started to plan for what we could handle, what we could actually manage, and what would be a stretch too far. And so we started to push a lot of assets that were overseas off the table. We needed to find the right asset out of, and I think we put in, I'm trying to remember the numbers, I think we put about 318 projects into the start of the pipeline. We whittled it down to, I think, about 20 that we took onto advanced diligence. We got down to about 5 that we signed term sheets on. And then we finally got down to 1 that we actually did a deal on and executed. And I'll talk a little bit more about that, that transaction and how we did it, because it was an interesting story. Then we had to find finance. And the problem that we had in finding finance was we were in the worst market for mining that has been around since the early 70s. Craig Williams is a little bit older than I am, and he's been around since that time. And I couldn't ever remember a market that was as hard as that in that sort of 2011, 2012, 13 type era. And Craig couldn't remember anything prior to that, to the 70s. That was that hard, trying to find money. So we then did the same thing. We had to look at a lot of different financing options, both debt and equity, and different components to fund it. So again, we started out with a lot of different options. We ended up we had 4 funding term sheets signed, and we had 4 funding term sheets all fall over at the last hurdle. And we'd just gotten to this point where we had looked at it every single time and said, okay, well, what happens? How do we fund the initial work that we have to do the diligence on the asset, then present the asset, secure the funding? So we all decided to self-fund that, which wasn't too stressful, but we put in, as a group, we put in probably between $2 and $4 million to get to that stage, which was the biggest risk that we had. And that was a risk that we all thought, well, if this doesn't work, we're okay, we're comfortable getting to that point. But if it does work, the payoff is quite large. So it became one of those situations where we looked at all the opportunities, and it was really, possible outcomes, it was really a binary set of outcomes. So it was either it would work, we'd find something, or it wouldn't work. So if it didn't work, we lost all our money that we'd put in. If it did work, then the potential payoff was quite large. So when we finally got to that stage of going, you know what, I think we're done here. We've spent about 2 years. So we went from the end of 2011, beginning in 2012, all the way through to Christmas in 2014. And so Greg and I sat with our wives up at a restaurant, Libertine, up in near the Caxton, and we had the smallest Christmas party a company's ever had, and said, I think we're done. We'll probably move on here. We've tried really hard. We can't get anywhere, and it's time to do something different. And then I think almost the next week, we had a phone call from another private equity company who said, we've just heard about what you guys are doing. It's come across our desk. Do you want to chat? And so when we thought everything was done, along came the solution that we'd been waiting for. And so we ended up signing a term sheet and actually completing another 10 months of diligence with them to get them comfortable. And then we finally got a deal, got an agreed financing deal, and then we had to close the deal with the people that we bought the asset from. So again, it was a situation of, we had to know everything inside and out. It was about knowing the detail, about convincing everybody. And again, it was something that was right up their alley. We needed a finance partner who was comfortable with the risk level that we were taking on and could see the benefit, which we ended up finding. And I think that was really just patience. It was about knowing that if we fell over, it didn't really matter. So we're all quite comfortable in our careers, but it's that desire to learn that I sort of find is a bit of a natural aspect. And it's about the patience and the tenacity to keep going at something and not being afraid of falling over. And I think I've actually described as tenacious by one of our board members at Lighthouse, but I actually think it was about being more patient. And so I think tenacity and patience can sometimes be confused. But that comes from both of those things, I think, come from understanding all of your options and being comfortable with all of the options, which is where we were. So we eventually got to the point where we had the money, we'd identified the asset, and then we sat down with the people selling it. And it was an Indian company called Aditya Birla. And it was an interesting negotiation because these guys had been burned in the past by different people in trying to sell this asset. They were completely out of their depth. As we said, it was one of those things where it was an asset that was being poorly run. It had been shut down and been on care and maintenance for nearly 10 years. And so they were quite weary about doing something. And every time we got to the point of thinking we were getting close, a problem would come up. And this comes back to, if you really want to get a deal done, one of the other lessons I've learned is that there's a solution to every problem. And it may not be the solution that you think is available or that you wanted to do, but there's a solution to every problem. And I think at the end of the day, we provided a few different solutions to them in the contract, and some of them are a bit difficult to go into because they're still subject to confidentiality agreements. But essentially, we structured the deal in such a way that we could save face for the head of the Australian operations for Aditya Birla. And once we'd understood that it was personal for him because he'd been embarrassed by other companies, and that reputation and credibility was a really big thing for an Indian company, we understood what buttons we needed to push. So we could actually restore his dignity by pushing in a number of conditional payments into the deal, which meant that the headline number for the sale for him all of a sudden looked about 3 times bigger than they thought they would get. But we really knew that we would never actually get there. So they were price triggered, conditional triggered, and we went, if we hit these things and we have to pay these amounts of money out, we've made 3 times more money than we thought we were going to make. So we were all, again, it came down to, let's understand what they need, let's give them what they need, but let's make sure if we have to give it to them, then we're not going to be uncomfortable with that. We're going to be really comfortable with that. So being price and production triggered, if we were hitting those targets, we were happy and we were well on our way. So we finally sat down and got that transaction done. And again, it was one of those cases of when we signed the deal, his pride had been restored. We'd finally got there. The asset or the private equity guys who'd funded us were happy. We were happy. Everyone was off to the start, off to the races at that point in time. But that was really just the start for us. So the really hard work then kicked in because we needed to build the thing and we needed to get it running. And it was a terribly difficult asset. And as much due diligence as we'd done, so I'm talking nearly 3 years of due diligence that we'd done on that site, when we finally got our hands on it, we were really fortunate that we'd spent time selecting the right team. So applying that same principle of knowing people by reputation and knowing what they can explain to me, we made sure that we had the right team, a core of the right team. And what we found when we got in there was there were a lot of things that weren't right about the asset that we hadn't seen in due diligence. But having the right people, that meant that we were actually able to turn some of those into positives as well. So we'd done that. So I'm just thinking about what the key for you there, in terms of getting to that point, no matter what we'd done, we still found that we actually had errors when we got there at the end of the day. But again, we could live with all of those errors because we had the right people that could fix them and we'd planned for all of the potential outcomes. One of the things though that we really learned out of starting a copper mining operation from scratch was you never quite have enough money. No matter how much money that you think you're going to have, working capital is king. So when you're starting a new business with incredible risks in the ground, but also incredible risks in pricing and commodity cycles, you can never have enough money. And no matter how much you think you've got, you won't. So just accept the fact that at some point in time, you will not have enough money and you need to be really clever about how you manage that time because you will be squeezed. So just moving on, how are we doing for time, Drew? Am I talking too much or? Pretty good. All right. Well, the back end. So I think we've, if we move on from that asset, then I think we could probably wrap up in that 5 minutes. I think there's some of the key lessons, as Jared said. Now, what we've done, we had finally got Lighthouse up and running, and we had the joint venture that we had with the private equity group was called Capricorn Copper, and the asset was up and running and producing. And we got to the stage where they wanted to go off and do some other things. They wanted to wrap the asset up and do a listing, which they're still planning to do. And of course, we said we have a really strong agreement, and you can't do that because we're a standalone joint venture, so you can't wrap it into another company. And we sort of dug our heels into the ground, knowing that at that point in time, the best option was for them to buy us out, which is what they did. And it was probably a little earlier than what we wanted, but that really closed off the chapter for us as being successful. So we negotiated the exit transaction, and then again we all sat back and looked back at what we'd done with a lot of pride. So that gave me the opportunity then to sit down and say, okay, well now what do I want to do? And as Jared said, I took a completely left field bent, which sounds really strange, but after a bit of a break, I started working on setting up a microbrewery. So just in I guess wrapping this one up quickly, because there's still a lot of lessons, but what I did was pretty much everything that I've talked about and that I've learned in deal making, I've applied in this path. So you would think that setting up a microbrewery is easy, but I would say that pound for pound, the regulation on small business compared to the regulation on mining is out of control. It is phenomenally hard. So the lead time to start a microbrewery is a minimum of 6 months. We're at about, on our first one that we're looking at Ashgrove, I'm at about nearly 11 or 12 months in October. So and we're still not there with approvals yet. So we've learned to be patient with that one and plan, but we also then learned to look at different options. And so we've looked around the place at second options, and we found another site at West End that we were using as a plan B, but we've actually now gotten to the point that we've said, well, West End's such a good site that we took it on straight away. And whilst we were probably going to grow a little bit more, we just decided that we would take Ashgrove and get Ashgrove started, but we would start West End straight away, knowing that the lead times were quite long, and knowing that it was such a good site, such a good opportunity. So we really rolled with the punches there and decided that we would change our plans and be a little bit more ambitious. But I have my wife to keep my ego in check, so she's making sure I don't get too carried away with that as well. And the reason, as I said, the reason we looked at another site was simply because we had a lot of approval, I guess the lead time for approvals and the difficulties and resistance in approval meant that we really needed to sit back and say, do I want to do this? Am I happy if this falls over, we do nothing? Or do I want to do it? And I think the decision was, no, I actually want to do this. And so if that site falls over, I need to have other options. So we started simply looking at other options so that no matter what the outcome is, I'm going to be comfortable with whatever that outcome is. So I think just wrapping up, I think the 4 key lessons that I've learned is learn as much about everything in the business as you can. Make sure that you keep your ego in check, but you have to have a little bit of ego to get a good deal done. You've got to be comfortable with all of the possible outcomes, and that will help you be more patient with the deal that you do. And you really have to know when you've got the right people helping you, and when you don't, you need to move them on. So hopefully that has been useful.
I think, do we have like a minute if anyone has a burning question, or are there any on the Zoom? Yep.
Yeah, because you do not want to miss my voice. Oh, yeah. Listening to your story, how different is it to spend your own money versus $1 billion of your boss's money? Like,
yeah, it's it's very different. It's so much easier to spend $5 billion of somebody else's money than your own. It becomes a lot more personal. So both in the breweries and in Lighthouse when we were doing it, because we were putting our own money into it, we were putting our own capital on the line, and it was high risk. I lost more sleep doing that than I lost in any other deal that I did. And as I said,
So which one of those 4 lessons became even more important now that it's your own money?
the lesson of the most important one is being really comfortable, knowing that what are all the options that can come out, and knowing that I'm comfortable with all of those options. Because if it's your own money and you can't afford an option, and you realise that option, then you're blowing your brains out on something you can't afford. So that's the most important lesson for me, because you can't control the outcomes.
And a follow-on to that, have you noticed your own risk profile changing as you're moving into your own business space?
Yeah, I think absolutely it does. I think, and a little bit about the ego, it's a bit of a self-checking ego thing, I guess. So when you're younger and you are playing with other people's money, you're a little bolder and you sort of get a bit carried away with the environment that you're in. And particularly if you're sitting in a Wall Street investment bank office and you're looking out over New York and you're sitting there with these table full of guys and you're thinking, is this real, or am I doing a Hollywood movie? You just don't think about the numbers. The size of the check doesn't really become relevant. But when it's your own, your risk profile changes. And I think because you sweat on every decision, and you will second guess yourself even more every time it's your money that you're putting in, because you think, well, if I lose that, I don't get it back. It's not the same as if I'm doing something, well, I've lost that, but there's more money in the pool somewhere. Somebody has got a bigger fund. I can just tap that. You can't do that when it's your own. So it does. I think I've become more cautious, and I play back on that same rule that I play out more and more. What happens if I get this wrong? Yeah. And I've got to
probably. It's not a question so much, but you've come back a few times to talk about understanding all of the potential outcomes, and one of the examples you gave, which I loved, was that a potential outcome was not that we positioned ourselves differently to be taken over, but a potential outcome was that we actually flipped that right around and we took over the other company. And I actually, just a comment on that, not a question, but I really loved that, because that really, I think, demonstrated there truly was an open field for where these ideas could come from. It wasn't starting from a position of defense. We are being taken over. How do we maximize this situation?
Yeah, absolutely. Yeah, I agree. I think being proactive is a really important attribute, and that it sort of ties into the ego thing as well. Proactivity is really good as long as it's not your ego telling you to do that. You can do more than you can actually do.
Any more questions? Before we wrap up, let's get a takeaway from everybody. We've got a great one from Ben. And for everyone on the webinar, could you please put yours on the chat? So I'll give everyone a few minutes. Thanks, Carl.
Thank you.
We pay you in wine around here. We're a not-for-profit.
Thank you.
No worries.
That's excellent. Oh, that's beautiful. Thank you.
We just appreciate your time.
Oh, thank you. It was fun to do it. Hopefully it was helpful. Thank you. I might just put this over there.
Gerard, you got an awesome takeaway, and then
Yeah,
we're going to
that's great.
go around and...
My takeaway is really just understanding all the possible outcomes and being comfortable with those to make the decision on if you've got to change the plan or not.
Yeah, mine was actually play on other people's egos and think what they want from it.
That was a fun one.
I just think you're very brave, because Ashgrove and the Gap were actually originally planned as dry suburbs. That's a little history lesson there.
Always count on you for fun facts. Shivani?
There you go.
Mine was don't tell people what you're going to do, just do it.
Yeah.
Mine was leveraging your ego, but keeping it in check.
I'm done.
Have you got anything on the chat? Okay. Get the right people on and lose the wrong people.
Mm.
The importance of ego and how it can be a strategic tool. It's easier to spend $5 billion of other people's money than your own. Amen.
It is.
Awesome. Okay, great. Thanks for sharing, everybody. Gerard, I'll leave you to wrap up.
Excellent. Thanks for the opportunity to speak, guys. That was good.
Yeah, thanks again, Carl. Really appreciate that. And, Carl's obviously got a very impressive career, and now as an entrepreneur, still doing some great stuff. And he's a local guy. So one of the things that I want to talk about, or just remind everyone about, is the upcoming events. And on the 14th of October, we have another local entrepreneur, Phil St. Baker. And he's also done some really amazing things growing up in Brizzy. And yeah, it'll be incredible to hear his story about how he's taken a small family business to a very huge business a couple of times now through learning how to grow through vertical integration or selective vertical integration. So that's on the 14th of October. Then on the 30th of October, we kick off Movember down at the Gold Coast with Dr. John Bartlett having a talk with us, and we're going to have some beers and things like that. We probably shouldn't do that for Mental Health Month, but that's what we're doing anyway. And that's going to be really exciting. Nikki and the team have really selected a great place down there. That's going to be awesome. And then on the 4th of November, it's the AGM and the last man standing with Steve Bradbury. So hopefully everyone's looking forward to that. Thanks very much.